Welcome to Close of Business. I'm Alicia Barry. The world's largest miner, BHP, has played down its iron ore dispute with China at its AGM in Melbourne. The company is facing pressure from China to drive down the price of its iron ore, and negotiations around shipments have been strained. Rihanna Whitson went to the shareholder meeting and filed this report.
Outside the AGM of the world's biggest miner, it was almost a case of more police than protesters.
BHP has a lot of questions to answer, both in terms of its iron ore business and negotiations with China.
Inside the luxury hotel venue, shareholders gathered.
I'm just here with an open mind.
The shares have been doing really well, and so I'd like to actually put faces to the company.
Opening the annual meeting, CEO Mike Henry had a message for the federal government.
Australia can't afford to be flat-footed in the race for global investment. Every aspect of Australia's competitiveness, from labour productivity to the time and cost of construction to royalties and taxes, must be examined against competing investment destinations.
Having visited the White House before the Prime Minister, along with bosses from Rio Tinto, Mike Henry talked up the US-Australia critical minerals deal as BHP tries to develop an American copper mine.
Australia is quite well positioned to support the US as the US tries to de-risk its critical mineral supply chains.
The elephant in the room, reports that China would block BHP iron ore shipments in the midst of a pricing standoff.
We are in a commercial negotiations and we won't be commenting on any of the specifics. The only other point I'd make on this is we've had relationships in China now for decades. And we have a pretty good working relationship.
Everything is being negotiated. We will end up, as I said, at a negotiated outcome. Will we ever really know what was given away? I suspect not.
The talks between BHP and China's state-backed iron ore buyer CMRG go far beyond the company's next profit results. Lower iron ore prices are bad for government coffers. Some have suggested BHP could join forces with Rio Tinto to thwart China's determination to reduce iron ore prices.
At this stage, we're having no conversation. But it's, we always look at where's the infrastructure, where can we use it? Forget about it being Rio Tinto, it could be somebody else. But at this stage, there are zero conversations going on there.
Analysts have said if China stops buying BHP's iron ore, it could lean on the soon-to-be-opened Simandou mine in West Africa, a joint venture between Chinese interests and Rio Tinto.
It's built into our plans, and it's one of the reasons why we focused on getting to the bottom end of the cost.
It's 120 million tonnes. It's predominantly owned by the Chinese. I think the whole equity market globally is thinking, what does this do?
One thing is clear, BHP playing down US and China trade tensions.
I think a business like ours and a country like ours actually just needs to work with all parties.
BHP bosses are also facing questions about how long they'll work together.
So you'll still be standing next to Mike in 6 months' time?
Absolutely no comment.
BHP tight-lipped on many fronts.
The US dominates the global financial system, the Middle East oil supply, and China has a stranglehold on rare earths and the refining capability to go with it. This week, in a deal hailed as a landmark, the United States and Australia joined forces to break China's grip on critical minerals. But establishing a commercially viable refining industry may be years away. Warren Pearce is the head of the Association of Mining and Exploration Companies, and he joined me. Warren Pearce, welcome to Close of Business.
Thank you, Alicia.
The Prime Minister says there's an $8.5 billion pipeline of critical minerals projects. So what do we know about the deal with the US? Who gets what?
Well, what we know is that the framework agreement has been signed between the United States and Australia, which sets up some immediate commitments. Indeed, they were announced on Monday morning, looking particularly towards the gallium refinery in Western Australia, as well as the Arafura rare earth project in the Northern Territory. There's also an additional $1 billion committed to be spent in the next 6 months, and then a range of the further expenditure or further commitments that are under prospective joint investment by the United States and Australia. And that's where the majority of the $8.5 billion of projects comes out. That's not just rare earths, but it moves into mineral sands, gallium, graphite, scandium, as well as magnesium. So it's actually a quite wide-ranging deal that looks particularly to the US defence industries, but also some of their commercial supply chains and advanced manufacturing.
So the US is going to access these minerals for those particular industries?
Yes, that's right. So what essentially we're doing is providing a situation where we can arrange for the financing and the building of these projects to provide rare earths and other critical minerals into the market where China holds a stranglehold over the overall supply of these minerals and their value-added products. So with the United States as a partner and their industry as the commercial offtake, so to speak, that's the ability to enable us to finance these projects, build them, and then provide them to a customer who can buy the product.
Well, as you indicate, China not only dominates the production but the refining of these materials. Is that how it's been able to weaponise the sector in its trade war with the US? Absolutely, they are in a very dominant position. So they produce about 70% of the world's mined rare earths and do about 90+% of the refining of rare earths, as well as about 90+% of every product that's created after, including rare earth high performance magnets. So they're in a powerful monopoly position, essentially to dictate to the rest of the world. And indeed, as we've seen the last couple of weeks, they've continued to extend their export controls over rare earths, particularly heavy rare earths, going into defence supply chains, and are making it quite clear they intend to use their monopoly power to make it very difficult for other countries working together to essentially break into the rare earths supply chain. Iluka's managing director Tom O'Leary has put it bluntly, saying China is manipulating the price of these unprocessed rare earths to put rivals out of business. Is that a risk?
Absolutely, and we should expect them to do that. Now, I think it's fair to say China's not the only nation to use these types of practices. Indeed, when you see corporations in a monopoly position, they use similar types of practices. What they've tended to do in this space is flood the market with cheap supply of rare earths, which has made every other competitor uncompetitive on cost and unable to essentially finance and build projects and supply into that market. They've got the ability to make up those costs as they control the rest of the value chain, and they can ultimately pass those additional costs on to the customer somewhere further down the value chain.
Well, we know China can play dirty. It has used misinformation against rivals like Lynas through social media. It's rallied political opponents, flooded the market to push prices down. Is this a fair competitive playing field that Australia is entering into?
No, not at all. And that's the reason why we're doing it with governments. So that's the reality of Australia being able to do this, Australian industry being able to do this own. There is simply really a very limited opportunity without the support of a major partner, the United States or nations like Japan and South Korea. So if you look at what happened with Japan, in 2010, China cut off all rare earth exports to Japan. Japan responded to that by essentially trying to build their own supply chain and underwriting the Lynas rare earth project, which now supplies them with their rare earth needs.
How long would it take for Australia to reach the refining capacity of China? They have been at it for decades.
Look, that may not be the entire goal. The reality is we're going to be a long way for doing anything like matching the output of the Chinese. Earliest we'll get likely to get rare earth refining processing up and running in Australia is early 2027 with the Iluka rare earth project that's being built currently, and indeed with Arafura looking to commence production in 2028. So we've got a way to go to enter into the market beyond that of Lynas rare earths, and indeed it will take us a considerable period of time to be able to ramp up both the level of production and value adding to those rare earth metals to begin to compete with China. But ultimately our goal here is to create a more open market, which indeed removes the vulnerability from the supply chains and enables Australia and our strategic partners to have secure access to the critical mineral supply chain.
The Bank of America chief economist Helen Chow was on the program last night. She says there's a risk that this strategy by China using critical minerals as a bargaining chip could backfire as countries move to circumvent China, leaving it with a smaller market. Do you see that happening?
Well, there's certainly going to be a response from Western nations. The reality is China's using this position as leverage in the negotiations with the United States and indeed with other countries who need to secure these products. So I think there will absolutely be a reaction. That reaction, I think, is going to be to drive governments off the sidelines into market interventions and to try and build their own supply of critical minerals, which is exactly what the United States is doing here with Australia.
Warren Pearce, thank you so much for your time.
Thanks, Alicia. It's a pleasure.
Silver has been shining for investors with a recent record-smashing rally. But this week, the precious metal suffered the steepest sell-off in years as investors locked in profits. The price tumbled more than 8% before stabilising. Despite that, as David Taylor reports, demand for silver is only growing.
Increasingly sought after for its use in military hardware to powering renewable energy. Experts say there's simply not enough silver to go around.
There's industrial demand for silver. Silver has a role in certain types of advanced chips that gold doesn't, and there's more demand for those coming from, among other things, the AI revolution.
Every precious metals bull market is the same. Silver always outperforms gold to the upside, and in the bear market, silver drops harder than gold to the downside.
The shiny metal suffered its biggest one-day fall since 2021. That comes after recently hitting new record highs. Silver's had quite the journey over the decades. The years leading up to and during the global financial crisis saw another silver price boom, then bust. And before that, the late 1970s boom ended with the so-called Silver Thursday crash.
It is worth what someone thinks they'll be able to sell it for at some point in the future. Some people say that when ordinary retail investors are jumping on a bandwagon like this, that's the time for the professionals and the big players to be getting out.
But that's not something this silver manufacturer is seeing yet.
So we're kind of always up against it. There's always more work than we can do. To be honest, there's always too much work and not enough people to do it.
Economists say the erosion of the US dollar on the back of soaring government debt and the prospect of lower interest rates has been driving the silver boom.
I think it's this combination of a safe haven in times of uncertainty, a hedge against fears of inflation.
The plunge in the price of the shiny metal has raised questions about whether the silver bubble may be popping. But analysts trying to forecast the price, trying to predict the next move in the market, say the price has further to go up.
Silver, from a technical analysis perspective, is just broken out of a 45-year cup and handle pattern, broken out above that key $50 level that it hit first in 1980 and then again in 2011.
But it's not a boom Australia is going to massively cash in on. Economists say we don't have anywhere near the reserves of silver compared to gold.
We're not going to be as big a player in global markets as, for example, Mexico, Peru, Argentina and the like will be in silver, or that we have been in iron ore and potentially can be in some of what are now called critical minerals.
So take me through some of this jewellery here. What have we got?
So these are all engagement ring designs.
And for those who fancy a bit of bling or a ring, this Sydney jeweller is carving out new products to meet rising demand.
Well, our jewellery is turning over pretty rapidly. So we do have records of how many grams of gold we've got, how many grams of silver we've got in our studios, in our safes, on the workbenches. So the value, I guess, of what we have is increasing.
And Kate Reid says demand often feeds on itself.
As Christmas approaches, we get a lot of engagement ring inquiries. So people love the idea, they're at a wedding, they're with their family, with their friends and celebrating love, and they're like, oh, we should do this too. And then we'll get the wedding ring uptick straight after that.
A silver lining in a turbulent market.
A glitch at an Amazon data centre in the US brought half the internet's traffic to a standstill earlier this week. The major outage knocked out websites and popular apps including Snapchat and Reddit. Experts say it's exposed how reliant the world is on just a few big cloud computing companies. Here's Nassim Kadem.
Amazon's cloud computing service, AWS, is still struggling to recover
after the outage that broke the internet.
From banking services to airlines, dating apps to gaming platforms, a major outage at Amazon Web Services sent millions around the world into disarray.
I messaged heaps of people on Snapchat, so I couldn't message anyone last night.
It was not a good feeling.
It was annoying because I kept thinking it was something wrong with my phone.
The hours-long outage overnight exposed how reliant much of the internet is on the company's cloud infrastructure, taking down websites including big names like Snapchat, Zoom and PayPal.
So these kind of incidents are a risk to all of the IT infrastructure that we depend upon and financial systems.
Some businesses that use AWS weren't impacted because they had a backup plan.
We made a business decision to make sure we had diversification in our suppliers. So we didn't have all our eggs in one basket.
That's a lesson that other local businesses that have been hit by the outage, including Atlassian, Canva and Xero, have now learned. Atlassian told ABC News its teams are continuing to monitor the recovery. Canva said service has now been restored for many users, while Xero said customers may still experience general slowness and errors.
We really need to be looking at spreading our risk. So having a single provider, and the Australian government is a good example of this, they're very wedded into the AWS platform, means that you have a single point of failure.
AWS says that services have begun recovering and that customers can continue to monitor the situation online. While the company's reputation may have taken a battering, it's also exposed just how reliant the world's internet is on a few big players.
Optus says it's reshuffling its executive leadership team weeks after its 000 outage that's been linked to 3 deaths. Optus made the announcement as it prepares to front a Senate inquiry. Here's business correspondent David Taylor again.
2 senior Optus executives will leave the telco as it continues to face scrutiny over recent 000 outages. Optus has announced the retirement of Chief Financial Officer Michael Venter, who will step down from his role as a director on the Optus board next year. In a statement, Optus CEO Stephen Roux said Michael has decided to retire from executive life to pursue a portfolio career, and I wish to thank him for his significant contribution to Optus over the past 4 years, including the time he spent as interim CEO before I joined the company. Chief Information Officer Mark Potter will also depart Optus in March 2026. The governance changes at Optus have been described as part of a planned leadership transition. Optus has suffered a series of scandals in recent years, the most recent being an Optus network upgrade in September this year that led to a 000 outage, which was linked to 3 deaths. The Greens and the Coalition are expected to vote through a motion on an inquiry into Optus when Parliament meets next week.
House prices in all capital cities are rising at the fastest rate in nearly 4 years, with Sydney, Brisbane, Adelaide and Perth all hitting record highs in the September quarter. Domain's latest house price report shows Sydney house prices have had their strongest growth in more than 2 years. The median price of $1.75 million is on track to surpass the $2 million mark by 2027. Brisbane has officially become Australia's second most expensive city to buy a house, with Melbourne close behind, and Perth looks set to join the $1 million club by the end of the year, while several cities are seeing unit prices rise even faster than house prices. To the share market, which managed to finish the week on a positive note. The ASX 200 and the All Ords were both up 0.25%. Gemma Dale from NabTrade joined me. Gemma, gold prices recorded their biggest drop in 5 years in one day this week. Do investors think that this is a buying opportunity, or are they perceiving the chance has passed them by?
Such a good question. I think this one we have to put in context. I mean, the gold price is up. Well, it's well over 40% now, but a week ago we were saying well up over 50% over 12 months. So it's been an extraordinary run for an asset that is very hard to value and frankly should be the safe haven asset in your portfolio if you hold it at all. And many investors do not and have not for many years held gold. It's not sort of been in financial portfolios for quite some time. You have to go back a few decades before it was, considered critical to a portfolio. So we have this interesting development at the moment where some investors who've never had exposure to gold are not too worried about how hard it's run, but simply going, I don't have an allocation to this asset. I can see the argument that it is some ballast in an environment where you've got enormous levels of global debt and we're worried about fiscal stability and so on. And then others who are going, it's run so hard, I'm trimming my position. So we see both at the moment from investors. They're doing those through financial instruments, through ETFs and so on. But it's interesting, it's not a consistent pattern.
We saw silver crash this week too. Is that related to what's happening in gold?
Look, the correlation is usually there between gold and silver. I mean, we don't see our investors showing any real interest, to be honest, in silver. It's just not considered a proxy. It's a less expensive proxy, obviously, but it's just not considered one for our investor base. They don't tend to buy the physical asset or an instrument that gives them exposure.
Well, the energy sector was up 2 days straight. What was behind that?
Yeah, so this is an interesting one. I mean, there's been a lot of sort of downward pressure on the oil price for quite some time, so it's not like that's been running super hot. Gold's been the favourite. And what we've seen, so the big news that was driving it overnight anyway, but not so much yesterday, we were a little ahead, was further sanctions on 2 big oil producers out of Russia. The challenge is that regardless of sanctions, that oil tends to make it to market. The routes might get more expensive and more complex, but they're making it to market eventually. So I don't think anyone believes at this point that that is going to be continuing upward pressure on the price.
Our critical minerals miners and explorers were really in focus this week after that landmark US-Australia deal. How have they performed?
Yeah, it's been interesting. There's been a lot of appetite for particularly rare earths over the last, let's say, 12 months. And if you look at Lynas, for example, it's just been straight line. It's been incredible. They're very volatile, and they have been volatile for a long time, some of these stocks. But the appetite is there to get some exposure. And then when you see an announcement like this, a lot of investors have taken the opportunity to take profits. It's difficult to get detail. And then we also see, because we expand it to critical materials rather than just specifically the rare earths, the lithium coming in and so on. But again, those are well off their highs of a couple of years ago. Interesting to see where they go from here.
Absolutely. I mean, when we look ahead on the economic front, we do have the inflation numbers out next Wednesday for the quarter. Last week's jobs numbers put the possibility of a rate cut back on the table. Is it likely the CPI could undo that?
Yeah, it's a really interesting question. At this point, we're not anticipating another cut until May next year. So the data has changed quite a bit, and the jobs numbers are putting a fair bit of pressure on the RBA, as you say. CPI's tricky. It is clearly lifting. It is above the target band, we think, and we're expecting a sort of hotter than previous print. All of those energy subsidies are rolling off. I mean, everyone's kind of looked through those, but they're rolling off, and we're also starting to see lifts across lots of different components. So there's pressure there, and I think the concern is that unless there's a real deterioration in the jobs numbers, it'll be the CPI that's making things difficult.
Gemma Dale, thank you so much.
Thank you for having me.
Private hospital group HealthScope is facing a backlash after putting a proposal to staff that says it would allow it to keep its hospitals running if it doesn't find a buyer. The company, which collapsed into receivership in May, says it could become a not-for-profit and access staff tax breaks to stay afloat. Daniel Ziffer reports.
Broke and desperate, Australia's second largest private hospital operator is trying everything to stay alive, even taking tax benefits from employees.
It's still highly objectionable. We've never seen anything like this. We see as just pure and simple tax fraud.
Administrators for HealthScope want to take advantage of tax benefits only charities can access.
Salary packaging reduces a worker's taxable income by not taxing a chunk of it. The benefit goes to individuals, but HealthScope wants that money for itself.
Union leader Kate Marshall is leading the charge against a plan that would see HealthScope turn itself into a not-for-profit hospital operator, allowing staff to access the tax benefit that the company would then take up to a 90% share of.
What HealthScope are proposing is literally taking money out of workers' pockets to pay their billions of dollars worth of debt.
Employees are able to salary package up to about $9,000 a year for living expenses, and around $2,500 for meals and entertainment. If staff access it, it could cost taxpayers tens of millions of dollars in foregone revenue.
This is a phony use of a non-profit status in order to create private wealth.
In a statement, HealthScope said administrators are putting forward a salary packaging option that provides for both significant financial benefits to staff while helping to support the viability of a not-for-profit HealthScope. In late 2019, Canadian-based asset manager Brookfield snapped up the healthcare group for $4.4 billion, then lumbered HealthScope with $1.6 billion in debt before the hospitals collapsed into receivership.
This is a company that has over $1 trillion in assets and has mastered the art of profit shifting and not paying its fair share on hugely lucrative investments in Australia.
Brookfield declined to comment. A charity called Pearce has been successfully registered with the Australian Regulator of Charities, which declined to answer questions about the listing due to confidentiality rules.
Charitable status is there for the benefit of the public, and if it's to be used for private or commercial gain, then entities stand to lose not only the trust of the public but also their charitable status.
In an email to staff, HealthScope CEO Tino Laspina said employees could receive 100% of the salary packaging benefit for at least 3 months. After that, if 90% of them took it up, they could receive 40% of the benefit. Unions say staff are being told that if they don't sign up to the proposal, hospitals could close and they would lose their jobs.
I think members just think that it's completely unfair. Why should they be the ones to bail out HealthScope and what's happened to them financially?
Sparking concerns about the potential precedent it could set, particularly in the cash-strapped NDIS sector.
What would happen if a disability provider went under and then decided, hey, we've got this model of what HealthScope's doing, let's offer salary packaging and let's take the majority of the benefit to get us out of debt?
Whatever happens, a difficult deal.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.